So, what are the fundamental rules to a high score? What kind of benefits do you get long term, short term, and immediately? So, one of the things that I always like to tell my customers is look, if you're aiming to get a certain credit score, have things that go along with it. And today I want to break down the concept of what we call the R.T.S strategy. And R.T.S is essentially what's the usefulness of having a high score in comparison to a low score. And when we talk R.T.S, I want you to think about the methodology of, hey, with this R.T.S method, I can calculate what are some of the probabilities in terms of funding, the size of those transactions, and what kind of amount of transactions I can do. So with that said, let's get right into it. The first thing is, you guys know that I'm a big advocate to help you guys push your scores forward. Whether it be, we were at 600, low 600s, it could be 500s. And you want to always perpetuate. You want to go into 700 and then the 800 range. Now, to get to that level, you absolutely have to go through certain processes. And there's a reason why I put out great content in terms of use the PI minimizer technique, use the item anchoring method, use the MVP, use the 15-day power surge. Heck, use the Trident wave. But at a certain point, you might get stuck, right? At a certain point, you might think to yourself, hey, I'm doing all these methods. I'm trying my best to get ahead, but I'm not really moving anywhere. And sometimes the credit bureaus can be stubborn, and sometimes it's just because in the past there were certain other companies that took your file and disputed it on your behalf and did all these great things. And unfortunately, they didn't have the outcome or results. Now, in this situation, your objective is to make sure you're not stuck. So you got to move ahead, right? And that's where I introduced to you guys last week, the CDR credit sweep. The CDR sweep essentially boils down to attacking your credit reports, attacking third-party databases, and essentially, going forward on that. So I think the biggest thing in that CDR sweep also is the outcome of the score that you can potentially get. And with that credit score, you have a lot more leverage for yourself. That means that you can now use the R.T.S methodology to determine what kind of deals you want to do, how you're going to qualify, what kind of rates you're going to get, right? So let's break down the R.T.S methodology and why it's very useful for you. The first thing we're going to talk about is the R side. And the R really stands for rates. So if you have low credit scores, you guys already know that you're going to pay a lot higher rates. You're going to enjoy not as much as the benefits that you would get if you had a higher rate. That means that you're going to be strapped for cash every month because your rates are so high. That means if you have high bills, if you borrow to the max, those balances that you're carrying, a minimum payment on them with a high rate is going to cost you a lot more money than if you had a good rate, which is an obvious thing, right? But with it also comes the methodology of that kind of rate applies to multiple sides of financial services. It could be a rate that's going to give you better insurance premiums because you pay less. And there's laws that are being passed to say that, look, don't take a credit score to determine the rate of insurance. But at the moment, what happens is they're still using that. Until that is passed down through Congress or some sort of decision is made, you're still stuck paying the higher rates and premiums on your insurance, which is ultimately, I think, is a necessity for everybody. But your credit score is kind of impeding your ability to get a favorable premium amount, which is costing you a lot of money at the end of the year, right? So that's one of those things. Your car, for example, you want to get a brand new car, your car broke down, you're fed up of buying used cars and keep repairing them after. It's costing you a whole lot more money. Whereas if you were to just finance that car, it'd be a lot cheaper, right? It's a better alternative. You don't have to go to the mechanic every so often. But in that situation, you still have to worry about rates, which is the R, right? So if you have a low credit score, you're going to end up paying a very high interest rate with your car financing. It's going to cost you a lot of money. Whereas in the contrast, if you had great rates, your car financing is going to be a lot cheaper. So if you were to combine that, you can already see that there's cost savings in achieving a higher rate. And on a year-to-year basis, that's a couple of $1,000s back to your pocket. Now let's look at home financing. Right now, a lot of people out there, they say, well, I can get home financing, I can get a good rate. Even if I have low credit scores, I can still get some home. And that may be the case. But at the end of the day, isn't bringing money back to your pocket the goal here? Isn't it for you to have access to liquidity and building your wealth with that and reinvesting that instead of spending it? Isn't that the objective? So if it is, then if you have a lower credit score, that's actually hurting you from reaching those financial goals, to building your wealth. Now let's assume you have insurance, you're paying higher because you have a low score. Let's assume you have a car, you're paying a very expensive fee every month because you have a low score. Now you want to get into a home, you have to put a lot more down payment, which instead of reinvesting, you have to now apply towards that home. In addition to that, you're paying very expensive mortgage rates, 5.5%, 6%, whatever it is. But realize those costs are spread out in a period of 20 years, maybe even 30 years, right? That's a lot of money. That's literally hundreds of thousands of dollars. Just because of that measly credit score that's holding you back from reinvesting in yourself, to building your assets, your legacy, your wealth. So that's the effectiveness of an R. So if you have a low R, which is, first of all, if you have a bad score or a low score, your R's, which is the rates, is a lot higher, means your out-of-pocket expenses is a lot higher as well. Okay? Now we go to the T. And T literally stands for transactions. So with the low credit score, you're kind of limited in terms of the amount of transactions you can do. Right? But with a higher score, because you have access to a great rate, because you have access to a FICO score that's amazing, you can actually do more transactions. Right? So if you look at, assuming like you want to apply for credit cards, you'll have a greater amount of success in those transactions than you'll have with a low score. Because you could get denied with a low score, but with a high score, you can actually get approved, right? So let's assume you apply for 10 cards, hypothetically speaking, you have a higher score. Your chances of approval on those scores, because you have a higher score, is high. Whereas with the same amount of transactions, which is like, the amount of credit cards you're applying for, let's say 10 of them, with a lower score, your chances of approval are very slim. You probably get 1 out of 10, maybe 2 out of 10. So the amount of transactions you can do in terms of getting qualified with a FICO score that's lower is much less. But if you have a higher score, right, outside of the R, which is the rate, you get better rates. Your T now, which is the amount of transactions you can do, is elevated if you have a higher score. Now we get to the S, because we talked about the R.T.S. R is being rate, T being amount of transactions, and S stands for the size of those transactions. So the higher score means that you can actually go out there now, and based on the amount of transactions that you do, they can be a very high amount of transactions. So for example, with a low score, you probably get X amount of dollars. So let's say you apply for a credit card, you probably get $2,000, $3,000, maybe even $1,000. But with a high score, right, depending on your credit history and how built out it is and what kind of structures you're working with, you can actually get $10,000, $20,000 credit card. So the proportion to the amount of transactions, the size of those transactions are a lot higher. So you're actually banking and you're trying to make the most benefit from that perspective. So that's where the R.T.S. methodology really helps to identify where you stand with your FICO score. Now, I know you guys already know the basics of it, but if I were to give you on a financial term and show you the effectiveness of having a high score just by using the R.T.S. methodology, you'll now understand that you can actually put thousands of dollars back into your pocket. You can increase the size of your transactions, and you can do more transactions at the same time. So that's why I think that your credit is actually what is the reason why I say it's the cornerstone of your wealth. It's because that is the actual reason. It's because if you have a higher FICO score and a credit score, the rates are lower, which means cash back into your pocket. The amount of transactions you can do is incrementally increased, which means you can go out there and do more with your credit. And the size of those transactions are a lot larger, which means you can make a lot of benefit if you use it right and reinvest it right, which means ultimately money back into your pocket, and you're building your wealth with that. So use the R.T.S. methodology to understand the risks that you carry based on your FICO score. And like I always invite you guys, you guys know that the CDR sweep is out there. I created a financing plan. It is definitely a commitment you have to put up, but it's investment in yourself. Just using the R.T.S. methodology, if you think about the cars, the credit cards, the homes, the insurance, all these type of things that can literally benefit you and your lifestyle, don't let that be a factor for holding you back to investing in yourself, right? So consider the credit sweep. It's very, very powerful, very thorough, and very actionable. I think you will enjoy the process as we do it. In addition to that, you get some free benefits, right? You get access to my course, our Facebook mastermind, and you get me as a mentor directly guiding you every step of the process on a month-to-month basis to help you reach your financial goals. I think that alone is very critical, because people actually do need guidance and mentors along the way. They kind of forget that. It's not just being alone, but having me access to helping you, basically, buying access here, gives you a lot more leverage, All right, you can do the R.T.S methodology, but with my guidance in the process, you'll be able to enhance that to make the most of it, right? A little tweak will help you get a lot farther much faster, okay? So I want you to keep that in mind. I want you to really pay attention to the R.T.S methodology and really use it to heart. Look at your FICO scores and think about what's the R's. What are some of the possibilities of the rates I can get based on my score today to if I were to increase my score. Look at the T's, which is the amount of transactions you can do. If you have a low score today, how much T's can you do? How much transactions can you really do? Whereas if you had a high score, how much transactions can you do? Do a comparison analysis. And then finally, think about the S, which is the size of the transactions. Right? If you have a low score, what are the potential size of your transactions? Where in contrast, if you had a high FICO score, there's no telling of what kind of transactions you can do. But like always, the CDR sweep doesn't just look at the credit. It looks at your snapshot as a consumer as a whole. Because there's a lot of databases out there, and trust me, recently, more than ever, different types of individuals like tenants, landlords, insurance companies, you're looking for homes. All these other repositories are being used more and more. So if you think about that, I think the CDR sweep is a must because you have to use that and integrate that into your process. It's not about credit anymore. It's gone beyond that. It's evolved beyond that. We're in 2019. It's about data repositories, about your privacy. It's about protecting yourself on a score level. It's about increasing your leverage. So you have to think about your entire consumer snapshot in order to tackle your financial objectives. So I hope you guys learned quite a bit. Once again, the R.T.S. So R stands for rate, T stands for transactions, and S stands for size. So the lower your score, the less probability that you'll benefit financially because you'll pay higher rates. Once again, you'll have less amount of transactions you can do, and the size of those transactions will be small. Whereas if you had a higher rate, if you had a higher score, your rates are lower, which means cash back into your pocket. You can do more transactions, and the size of those transactions will be a lot more conveniently larger. Okay, so with that said and done, I hope you guys enjoyed this video. Don't forget to give this a thumbs up. Share this video with those you feel will benefit from this content. Leave me a comment below on what you learned today. Do you feel that what are some of the first things you'd apply towards your financial goals? Would it be the R, would it be the T, or the S? And ultimately, I invite you guys to, if you haven't done so yet, subscribe to this channel and turn that bell icon on. And more importantly, if you're considering the credit sweep, don't wait around. I definitely want to see you on the other side, help you get to your financial goals. And I hope that we can work together. Once again, this is R.T.S, your guide and mentor. I'll see you guys next time. Bye for now.